What is the absolute best way for a beginner to invest just $100? It's a question you hear all the time, and you get 1,000 different opinions. But you know what? Instead of opinions, we're going to look at some actual data. We're going to break down a real-world experiment that tried to find the answer once and for all.
You know, the idea was actually brilliantly simple. Take $100 and invest it in 5 of the most popular and accessible options out there. And then, just let it sit for 4 years. No tweaking, no panic selling, just a pure, untouched test to see what would happen.
Okay, but here's the thing. This isn't just about which one made the most money. To really find the best option for a beginner, each investment was judged like it was in a contest, based on 5 specific criteria that are honestly super important for anyone just starting out. So, the whole competition was framed around these 5 key things. First, the learning curve. How hard is it to get started? Then, passive income. Can it actually make you money while you sleep? What about tax efficiency? How much of your profit do you really get to keep? Of course, the risk level. What are the chances you'll lose your money? And finally, the big one, the results, the actual numbers after 4 years.
All right, here's the game plan. First, we're going to dive into the high-risk, high-reward contenders. Then we'll look at the investments that are more about stability. And we'll wrap it all up by revealing the winner and what I think is the most important lesson from this whole 4-year journey.
Okay, let's kick things off with the heavy hitters, right? The investments that promise these huge returns, but yeah, they come with some serious volatility. This is the category where you can see massive gains or, well, the exact opposite. So let's meet our first contender, individual stocks.
So when you invest in an individual stock, you're literally buying a tiny piece of a company. You're essentially betting on that one business to do well. And you can make money in 2 main ways. Either the stock price goes up and you sell it for a profit, or through dividends, which are basically the company sharing its profits directly with you.
So here's the trade-off, and this is really the crucial point. Yeah, stocks get a great score for tax efficiency, especially if you're using accounts like a Roth IRA or a stocks and shares ISA. And they've got good passive income potential from those dividends we talked about. But, and this is a big but, they come with a high learning curve and a high risk level. You really have to do your homework.
So how did it do in the experiment? Well, a blindfolded, kind of random pick landed on Samsung stock. And after 4 years, that $100 was only worth $67.72. That's a loss of over 32%. Like the creator of the experiment said, and I quote, "This example perfectly shows how hit or miss individual stock investing really is." Think about it. If that dart had hit Nvidia instead, that same $100 would have become over $900. Wow!
All right, next up in our high-risk zone, cryptocurrency. You can think of it like digital money, all secured by this cool technology called the blockchain. And the most famous one, Bitcoin, gets called digital gold all the time, mainly because just like real gold, there's a limited, finite amount of it. And when you look at crypto's report card, it becomes very clear why it's in this high-risk category. The risk level, very high. That's the highest of all 5 contenders. And its tax efficiency is poor, mostly because you can't stash it in those sweet tax-advantaged accounts. It does, however, have some decent or moderate passive income potential through stuff like staking, which is kind of like earning rewards for helping keep the network secure.
And the final result? An absolute explosion. That $100 in Bitcoin, it skyrocketed to $652.24. That's a mind-boggling 552% return. But listen, this is where context is absolutely everything. That kind of growth is just wildly unpredictable. That number right there, it perfectly captures what extreme volatility looks like. It is the textbook definition of high risk, high reward.
Okay, so let's put these 2 high-risk players side by side for a second. With stocks, your returns are tied to a company's actual success in the real world. With crypto, it's all driven by supply and demand. Stocks are super regulated, which gives you some protection. Crypto, on the other hand, is still pretty much the Wild West. And probably the biggest difference for a beginner investor, stocks have those awesome tax benefits that crypto just doesn't.
All right, so we've seen the high flyers, the ones that can go to the moon or not. Now let's totally shift gears and look at the slow and steady contenders. These next 3 are generally designed less for those explosive overnight gains and more for protecting and just steadily growing your wealth over the long haul. First up, we have something called a REIT. That stands for Real Estate Investment Trust, and honestly, the best way to think about it is pretty simple. Imagine thousands of people all chipping in money to buy a huge office building or a shopping mall. As an investor, you get a cut of all the rent money that comes in, and you never, ever have to deal with being a landlord. Pretty cool, right? Now, looking at its report card, that great rating for passive income is what really jumps out. And there's a good reason for that. By law, REITs are required to pay out at least 90% of their taxable profits back to shareholders in the form of dividends. So you combine that with great tax efficiency if you hold it in the right kind of account, and a totally reasonable medium risk level, and you've got a really appealing package, especially for anyone focused on income.
So what was the result? Well, the REIT had a very modest gain, ending up at $101.52. And what's interesting here is that the value of the investment itself actually went down a little bit. See, this particular one was focused on commercial real estate, which, really struggled after the pandemic. But, and this is key, the strong dividends it paid out were still enough to push the total return just over the line into the positive. It's a perfect example of their stability, but also their vulnerability. Okay, next up we have one of the oldest investments in all of human history, gold. Gold is what people call a safe haven asset. Its main job isn't really to make you a ton of income. It's to store and protect your wealth, especially when the economy gets a little shaky or inflation starts to creep up. And you can see its unique role crystal clear on its report card. Just look at that passive income rating, 0. A big old 0. Gold doesn't pay you dividends, it doesn't pay interest, it just sits there. Its value comes from the fact that it's scarce and people have trusted it for thousands of years. So with a low learning curve and medium risk, its whole purpose is protection, not aggressive growth.
And how did it perform? Well, that $100 in gold grew to $140.10. That's a really solid return of over 40%. Now, this was nothing like the explosion we saw with crypto, but it was steady, reliable growth that easily beat inflation during that period. It did its job as a wealth protector absolutely perfectly.
And that brings us to our final contender, the index fund. I want you to imagine buying just one thing that instantly makes you a part owner of the 500 biggest companies in the US. We're talking Apple, Microsoft, Amazon, all of them. That's what an S&P 500 index fund is. You're not trying to pick a winner, you're just betting on the whole US economy to keep growing over time.
And this is exactly why index funds are so incredibly popular, especially for beginners. I mean, look at this report card. It's fantastic. A low learning curve, low risk because you're instantly spread out across hundreds of companies, and great tax efficiency. It's basically designed from the ground up to be a simple, super effective, long-term way to build wealth.
And the result? The S&P 500 index fund delivered a fantastic return of nearly 80%. It turned that initial $100 into almost $180. This performance just shows the sheer power of betting on the market's long-term growth as a whole. It's consistent, it's reliable, and historically, it's a strategy that has really worked.
Okay, so after 4 years, 5 different investments, and some wildly different results, it's time to bring it all home. What do we actually learn here, and which investment really deserves the crown?
And here we go. This one chart pretty much tells the entire story of the experiment. Just looking at pure returns? Yeah, crypto was the runaway winner, no question. But it came with heart-stopping risk. The index fund, it delivered incredible growth with much lower risk. Gold was that steady protector we talked about. The REIT managed to hold its own thanks to dividends. And the individual stock pick, well, it was a total bust. This is just a perfect picture of the whole risk versus reward spectrum.
So what's the real answer then? Which one should you pick? Well, the person who ran this whole experiment, their own strategy isn't about picking just one winner. It's about using all of them. The vast majority, the core of his portfolio, is in that reliable index fund. That's the stable base. Then he sprinkles in smaller percentages of the others, a little bit of individual stocks, some REITs, some gold, and even a tiny slice of crypto to try and capture some of that potential upside while keeping the overall risk in check.
But at the end of the day, the biggest lesson here isn't about which specific asset is the best. It's realizing that the best investment for you depends entirely on your own goals. What this experiment proves is that even with a small amount of money, like $100, the results can be just wildly different. So the most important decision you can make isn't stressing about picking the one perfect asset, it's just deciding to get in the game, to start.